Hey guys, Mike here. So obviously another crazy swing in the market today ends up big, and it's definitely, one of those kind of rallies or whatever you want to call it, where you can see here, I mean, everything across the board was green, no matter what sector it was in, whether it was Cathie Wood stocks, didn't matter, whether it was banking stocks, biotech stocks, all the travel stocks across the board, gold, silver, uranium, even the crypto stocks were up for crying out loud. You go to Walmart, all the shopping stocks, all the social media stocks, even all the Chinese stocks were up big. Semiconductor stocks, and then of course your big dogs are up. And what's even crazier is Microsoft. I mean, Microsoft had no business being up today, but that's the kind of rally it was. And this is what sent the market red from the get-go, right? Microsoft lowers its fourth quarter guidance, citing unfavorable foreign exchanges, right? Because of the strong dollar. And so, of course, they have a lot of money coming from overseas, from customers. And, of course, they end up lowering their revenue guidance around between $52 billion and $52.75 billion. So not super, so not a big change there. Then you got your earnings per share between $2.24 and $2.32. And the bottom line is, this is, you saw Snap do it, you see Microsoft do it. I won't be surprised if other companies start to come out and do it, and it's just gonna be one of the norm, right? They're trying to get ahead of the ball, ahead of the 8 ball, ahead of the curve, whatever, and go ahead and get it priced into their stock now, so people aren't shocked and the stock drops, 10, 20% on earnings or whatever it is, because you'd rather under promise and over deliver, right? And so I think that's what you see companies start to do now, because I've seen where people saying, look, the end of the year guidance just isn't in line right now with what's actually happening due to what the Fed's doing and everything like that, and oil prices and everything else. But what really turned the market to me was two things. One, the market loved the fact that the employment was seen as somewhat softening, okay, in which maybe the Fed won't have to tighten as much because the employment's starting to soften up a little bit. But the other one was what OPEC did. They took a vote this morning, and so what they're going to do is they're going to increase oil production. Right here, as you can see, OPEC is going to increase production by 648,000 barrels per day in July and August to try to give some relief because of soaring energy prices. And I don't care what energy source it is. Look at utilities ready to jump 40%, which already are jumping 40% because of natural gas. But no matter what the energy source is, everything's jumping. And I'll tell you right now, some people I like to listen to, and I just do. And Josh Brown's one of them because he makes me laugh because he's blunt. I really like blunt people, and people don't really worry about hurting your feelings and stuff. And I'm actually a very blunt person in real life. I'm just kind of on here more laid back about it. But, he nails it. I don't always agree with what he says. But in this case, it's exactly what I was saying yesterday. I'll put that video at the end if you didn't see it, about what's going on with oil and oil prices in the U.S. right now. And he nails it.
I think this is a one-way trade, and that one-way trade is predicated on oil and gas prices remaining elevated and U.S. companies continuing to invest less than they ordinarily would have during previous commodity price spikes. So if this were 2005, 2006, they would be fracking and drilling their heads off. They're not doing that because I think the signal they're getting from Wall Street is keep up the great work, guys, with the profit growth. These are companies that many of which had been profit constrained no matter what the price of crude did for year after year after year. And now all of a sudden they're the belle of the ball. Oil and gas companies have gone from 1% of the S&P 500 all the way up to 5%, which historically is still low. I think there's still room for these stocks to work, and I really don't think it matters that much which one you own at this stage in the game. That will matter later if there's a down cycle, but right now I'm in IEO. Those are the producers. I don't want the large integrators that are hedging. I don't want to screw around with K1s and transmission stuff.
And don't forget to hit that like and subscribe button, guys, if you get something out of this. And just to show you what he's talking about, this is the ETF he's in, and look how overstretched these things are. 32% above its 300-day moving average right there. Never happened. You go back right here to 2014 during the last real oil price run we had. The highest it got above its 300-day moving average was around 13.5%. Okay, I mean, not even close to where we're at now. And just to show you like a smaller cap stock right here, and by the way, if you're on the other side of this trade when it happens, you're going to be a happy person. I mean, because these things drop like tech stocks when it finally, people shift profits out of there and go somewhere else. But this is a smaller cap energy stock. And you can see right here, look at this, 58% above its 300-day moving average. And if you look It's just like a rubber band every time. Look at this. This time, the last time I did it, 67% above its 300-day moving average. Boom, rubber band snaps back, ends up dropping around 25% before the next lift off. Over here, you can see it's even higher. Gets 79% above its 300-day moving average. Boom, massive drop very quickly, 28% in a very short amount of time before the lift off. And whenever you don't think it can go higher, it just keeps going higher. I mean, this is since the crash, but not even measuring this from the crash. The only thing you got to understand is when oil doubles in less than a year, it puts such a huge, huge strain on the economy, and it slows it down. And usually what precedes this is a recession, by the way, just to let you know. It's happened many, many times in the past. And we've already doubled oil price twice now. Look at that, in less than a year. I mean, look how fast it's moving. Right? I think overall it's up 258% in less than 2 years or something like that. And so, you know, that's just massive. You see these numbers here, and look at the amount of time it's taken to do this. It's just no amount of time at all. And so if you go back, you think, well, this must be pretty common for, you know, oil to double in a year. And it's very, very rare. Okay, that's why I'm saying when it happens, that's when you usually see a major recession precede it, right? And so you see it sells off there. If you measure it from the crash, which you see I didn't do in the other one because everything lifts off in a crash, right? I mean, it went up 230% in 810 days or whatever. But if you look right here, actually level it off, measuring from the same point I measured the one we're going through now, is only up 58%, right? But if you look what happened before, right? Look what happens here. Ends up going up 185% in about a year and 7 months, I believe it was. So it's a huge, fast-moving spike up, right? And then, of course, what happens? We end up having the crash because of real estate, interest rates. But guess what else it was a problem? Oil. I mean, energy, right? Look what happened during the dot-com. Look what happened this right here. 99 through, what was it, 2000, I believe it was. Now you have 151% move, or 148% move in a year, right? It moves up really fast, sells back down, and then continues to go up from there. And that's why you'll hear some people, they'll say, oh, well, this, you know, when oil doubles in a year, it drives us into a recession. It's like, no, it's just a factor that adds up, you know, into it really, because it affects everything, as we've seen already, right? We've seen it firsthand, personally, and everything else, how it affects everything. And so, you know, we'll see if this extra production helps at least curb the prices. We'll see. Right now, I mean, it seems like there's no end in sight to this. Every time we think it's coming back down, it goes on its next leg up, right? And it goes up really fast. And some people are targeting, you know, between 147 and 170 at this point in time through the summer months right now. And so we'll see. Again, you know, this is one of those rallies. When I see every sector, no matter what, and like a Microsoft putting that stuff out there this morning and still going from 2% down to going in the green, I get suspicious of stuff like that. But again, if there's no crazy headlines, because news is what runs this market, if there's no crazy headlines, that and algorithms, of course, there's no reason we couldn't have another 3 to 5 days, you know, and then start to sell off, right, before we get CPI data and the Fed meeting and everything starting to roll in like that. And so we'll see. I mean, you know, we'll see where the algorithms take us, I guess, is another way to look at it. And if it stays green, enjoy the green. You know what I'm saying? That's what I say. So, you know, hope you got something out of it. Hit the like, subscribe if you did, and I will see you guys tomorrow.